Let's also welcome Rajesh Kothari on the show right now. He's the CIO of Alpha Accurate Advisors. Hi Rajesh, good afternoon. Good to be speaking with you, and it's turning out to be a great afternoon for the markets as well. And in the last couple of weeks, a lot has changed in terms of the perspective, in terms of the fund flow for the Indian markets. Help us understand that how are you seeing the markets right now, and also any sectors that you believe that are looking good even in this environment?
Yeah, hi. So I always believe, that the maximum point of uncertainty always creates the maximum point of potential upside returns. And if you actually go through the previous two episodes, COVID time as well as Russia-Ukraine war, while the effect on economy was for 2-3 years, like Russia-Ukraine war is still going on, but the market discounted it much early. During COVID times, within 30 days, market came down by 40%. During Russia-Ukraine war, for the first probably just 90 days, market went down by 14%. But the effect on economy was for 3 years. So I think that this time is no different. The Russia-Ukraine war kind of thing, and therefore now the US tariff war kind of thing, they all have many parallels. So I think the effect on market by and large, if you ask my personal view, the effect on economy will continue, but market has already discounted the worst part of it. So from here on, like I mentioned during our last interaction on 9th April, that every day is going to be better day in terms of the news flow perspective. So the worst of the news flow is over. Whether worst of the market is over or not, only time can say. Very difficult to predict the short-term moves of the market. But generally speaking, when the worst of the news flow gets over, the worst of the sentiments gets over, and then the flows also starts. Even otherwise, fundamentally, the effect on economy is not much compared to many other economies in the world. And I think India is at a very, very right point. Of course, as a country, we need to do a lot of things to make sure that we do not waste this opportunity. Such opportunity comes probably once in decade or once in century. And I hope we don't lose that opportunity.
Right. Okay. That's the take coming in on the overall market. Rajesh, hi. Afternoon. Good to have you on the show. Just wondering what the impact of the new LCR guidelines is going to be on not just liquidity, but what it would mean for banks, given that RBI has now got a solid backing, it seems, for banks.
Yeah, I think, the banking is one sector which we have been bullish on from I would say, last 2-3 quarters. And it remains one of the largest portfolio composition for us. And not only the recent announcement, but if you look at from last, I think 3 months, series of announcements made by RBI to improve the overall liquidity in the system. And the liquidity is, is like oil. So once liquidity starts, the growth, the multiplier effect of that liquidity, you see in the system. So I think the both NBFCs as well as select banks will benefit out of it. But overall, I think that's very, what I would say, specific view. But otherwise, for the banking industry in general, these are good news. See, from the banking perspective, the asset quality is still one of the best, compared to last 5-7 years. We are not seeing any significant dent in asset quality. There were a lot of concerns and apprehension that the retail side of credit asset quality may start getting kind of a poor. But if you look at the recent results by the two largest banks, there again, the asset quality has been doing extremely well, even on the retail side of the book. So I think the asset quality is still holding up. Inflation is coming down. Interest rates are coming down. The liquidity is improving. And therefore, I hope that finally, from second quarter onwards, the credit growth improves. And I think that's one important thing what we all are waiting for, that the non-food credit growth, I hope we go back to those days of 12, 14, 15% rather than, 8, 9, 10%. And valuation-wise, we are still comfortable on banking. So it remains one of the largest sector in our portfolio.
All right, that's the view coming in on the banking space. But if you look at the diagnostic space, that is also doing pretty well for itself. Well, of course, stocks like Dr. Lal PathLab, they are holding up well. But one such stock that is up around 10%, Kunal, what I can see is Thyrotech. Because in NSE 500, that's the second gainer of what we see. And like you were just also mentioning the fact that this is the first time that we are seeing the broader end of the market participating. Do you believe this is the stock or this is the space to look out for, because it's a low beta and the volumes are also quite low?
Yeah, so this tells you that the markets are now looking out for more trending opportunities. This also tells you that the markets have started to open up the risk appetite, not just in terms of short covering, but in terms of starting to build portfolios, as well as look out for quality stocks at discounted prices for these kind of sectors. So I believe that's a positive sign overall, and that's what generally distinguishes a short-term rally or a bounce back or a dead cat bounce into more of a trending move into the indices. Because when you see the market breadth opening up, when you see the risk on appetite coming back, when you see long built-up formations into such kind of names, that generally uses confidence into overall market. And again, I think today's move for Thyrocare is on the back of some extremely strong volumes. The volumes today on the cash on the NSA segment is almost twice or thrice the volumes over the last average of the last 5 to 6 days, when the stock was just about trading with a very mild kind of a positive bias. So that itself indicates that we could be looking at a cusp of a breakout for many of these stocks, including Thyrocare.
Interesting. That's the take coming in on the diagnostic space. But Rajesh, what is your own view? I mean, I know it's not the fancied and sought after sector in the market right now, but the entire healthcare diagnostic space, hospitals included in there, anything that's looking good?
Yeah, I think healthcare is one of the large portfolio weightage for us. For us, the healthcare and pharma, there are multiple subsectors within that. So we have really low exposure to US linked businesses, so less of generics kind of a companies. And second box is the domestic pharma companies, and we like here a few names. I think it provides very good, what I would say, opportunity, keeping in mind next to 12, 18 months view. Third is basically the hospitals, and fourth is diagnostic. So we have a zero exposure to diagnostic, but we have a reasonably good exposure on the hospital business again. And here we are seeing a significant expansion by the top 3-4 players, and interesting opportunities are there in hospital segment. Of course, the fifth box is the CDMO. That's the one space which we have been bullish from last few years, and we continue to like CDMO as a space. Overall, I think the pharma as a sector will continue to provide solid growth, particularly in a macro uncertain environment. The growth is, what is going to be, I think everybody is going to look for growth, and it's not going to be very easy for other sectors to report that kind of a growth. So pharma and healthcare will continue to, I would say, attract the attention of the market, because growth is, solid, and the valuations are still reasonable compared to many other sectors where growth is missing and valuations are still absurdly high.
All right, but Rajesh, also help us understand what's your outlook on the auto ancillary space. The reason I ask is because for the OEM side, a majority, when it comes to the passenger vehicle segment specifically, they are more dependent on the domestic market. But auto ancillary as a space, a lot of these experts are highlighting stands a chance to win with China taking the tariff hit. Any particular segment that you believe where India could be the winner?
Well, I think, as you rightly said, the growth of auto ancillary is dependent on two things. One is, of course, the domestic growth, which is right now not that on solid wicket. Both four-wheeler and two-wheeler growth has been kind of a very low single digit, which is not good news for ancillary companies in general. And other is, of course, the export opportunities. Now, this third opportunity of this China plus one, that people have been talking from last 1 to 3 years, it is happening slowly, steadily. And we need to, instead of doing the sector-specific view here, we need to be stock-specific. And there are 1 or 2, 3 interesting opportunities here. We are holding one of the large auto ancillary company from almost, I would say, last few years. And that company is, of course, doing extremely well because the opportunity is content per vehicle, and that is going up. So I think, anybody buying auto ancillary just because of hope story, I don't think will be the right thing to do. You need to identify company, whether that hope comes right or not, a separate issue. But even on otherwise on standalone basis, the company must be gaining the market share. Company must be gaining the more clients and more markets and more geographies. And if that thesis plays out, this, what we are talking about, this China plus one can be the added trigger. But I think there are only 2, 3, 4 companies which can capitalize on these opportunities. And it is not so easy to move the supply chain from one country to other country, particularly in auto ancillary. It is a very, very long drawn process.
Okay, Rajesh, so good having you on the show. Thanks for your time as always.
Thank you.